What happens when a system that's supposed to be, a driver of investment and growth? What happens when it's described not just as inefficient, but as something, well, much more cynical, like a rigged casino?
Yeah, that's a really provocative question, and it's right at the heart of the source material we're diving into today.
Exactly. We're looking at an editorial, and it paints a pretty stark picture of Bangladesh's stock market.
Stark is definitely the word.
Yeah.
This document, it really doesn't pull any punches. Its core claim that the market isn't just flawed, it's predatory, a rigged casino, even an avaricious instrument designed to fleece the public.
Wow. Okay. And what's really striking, I think, is how it connects major crashes, specifically mentioning 1996 and then 2010, 2011.
Right.
It links them directly to political actions. The argument isn't just market corrections or, bad luck.
No, not at all. The source claims these were engineered, deliberately, to enrich a certain elite group, while ordinary people, well, they were devastated.
It's a really heavy portrayal. Disturbing, actually. Suggesting these weren't just like side effects, but maybe the intended outcome.
Precisely. That these were deliberate results, not just market forces playing out.
Okay. So our goal here is to really unpack this. It's a complex and troubling picture the source paints. All right, let's get into it.
Well, the editorial makes a powerful case right from the start with that casino analogy. It really leans into it. It pushes this idea that these weren't just, normal market downturns. No, it calls them deliberate acts of systemic predation.
Systemic predation, that's strong.
Very. And it brings in a quote cited from Dr. Debapriya Bhattacharya of the Center for Policy Dialogue, the CPD. He apparently said the market functioned less like a real capital market, for investment, raising capital, and more like a casino where, and this is the quote, profits are deposited into the basket of casino owners.
That comparison tells you a lot about the source's perspective right away.
It really does. It highlights the central argument that the system, at least in this view, was allegedly set up to benefit a specific group, and clearly at the expense of, well, everyone else.
And the source really zeroes in on that 2010, 2011 crash, doesn't it? Almost like a case study for this whole alleged problem.
Absolutely. It calls that specific event a brazen blueprint of state-sanctioned theft. It even uses the term grand conspiracy.
A grand conspiracy. Okay. And what was supposed to be part of this conspiracy, according to the source?
A dramatic artificial inflation. The source calls it an unprecedented artificial bullish run. It specifically points to the DSE General Index, the DGN. It says it was explicitly inflated to this unsustainable peak, 899.18.5 by December 2010.
And how does it back that up? How does it argue it was artificial?
Well, the main evidence cited is an astronomical PE ratio of 30 during that period.
Right, the price-to-earnings ratio. And 30 is generally seen as pretty high, yeah. Suggesting overvaluation.
Exactly. Very high. It suggests prices were way out of line with actual company profits. The source uses this as kind of a red flag indicator, proof, in their view, of how disconnected the market allegedly became from reality.
So the claim isn't just greed or market excitement getting out of hand.
No, the source argues this bubble was deliberately inflated. Inflated by a regime, it says, that dismantled oversight and actually encouraged reckless speculation.
So the conditions were allegedly set on purpose.
That's the argument, that it was intentional groundwork for the eventual crash.
And who were the main victims identified in this alleged scheme?
The source points to millions of financially unsophisticated retail investors, people who, it says, were desperate for better returns, got drawn into the frenzy.
And became easy prey.
That's the phrase used, yeah. Easy prey. It paints a very human picture, vulnerability being exploited by powerful forces.
So if we connect the dots the source is laying out, it suggests a system where manipulation wasn't just a bug, but maybe an alleged feature, designed to target those who couldn't really understand the risks.
That seems to be the core implication, yes.
Okay, this is where, as the source says, it gets really interesting. It goes into the specific mechanisms, how this manipulation allegedly happened.
Right, it gets quite detailed here. It starts with something called bogus market entries.
Bogus entries, meaning
companies with, and the source uses the term flagrantly fraudulent records, didn't just slip through the cracks, apparently. The claim is they bribed their way onto the market. Using tactics like bogus IPOs, that's initial public offerings, and sham asset revaluations.
So essentially pushing worthless stock onto the public via what the source calls a corrupt gateway.
That's the picture painted. Inflated prices for fundamentally flawed companies.
Okay, what else?
Then there's placement trading. The source describes this very negatively. Not as a normal private sale of shares. It calls it a legalized black market, a direct pipeline for illicit enrichment.
How so?
It claims shares that should have been available to everyone were, quote, stolen from the public and funneled directly to certain syndicates.
Syndicates, the source calls them.
Criminal enterprises, that's the term used. It alleges these groups then manipulated the market with predatory precision, artificially inflating prices, then unloading their tainted gains onto unsuspecting citizens. Those same retail investors again.
And according to the source, who benefited from all this?
Its specific network. Influential individuals, entrepreneurs, issue managers, and a certain class of investors. It wasn't random, the source argues. It was organized.
Right, an organized effort. And how are these transactions allegedly hidden?
Through something called omnibus accounts. The source is very critical of these, describes them not as standard accounts, but as architected loopholes. Explicitly designed, it claims, by the former regime to provide cover.
Cover for what exactly?
For large-scale illegal transactions.
Yeah.
Unfettered cover is the phrase used. And the scale mentioned is huge.
How huge?
At least BDT, 2.5 billion, was reportedly laundered through them. BDT being the Bangladeshi taka.
2.5 billion taka, that's significant. This level of detail from the source, it really suggests a deliberate, multi-layered system was allegedly in place.
That's definitely the impression the editorial gives, that this wasn't just a few bad apples.
Which leads to the next point, right?
Okay.
The source calls it a legacy of complicity and unchecked power.
Exactly. It argues this was systemic corruption, orchestrated from the very pinnacle of the previous power structure. That's a direct quote.
Wow. And it mentions a specific document, a white paper on the state of the economy.
Yes. The source claims this white paper really lays it bare, shows how powerful business groups who were loyal to and protected by the political elite, how they were able to ruthlessly manipulate prices with impunity.
Impunity. And it doesn't stop with business groups, does it? The source mentions the regulator to the BSEC.
It does. The source and other reports it cites apparently irrefutably expose BSEC officials as active participants in the fraud. BSEC being the Bangladesh Securities and Exchange Commission.
The regulator itself involved.
That's the allegation, that officials were deliberately exploiting legal loopholes, granting illicit concessions.
And there were specific allegations mentioned about bribery.
Yes, allegations about accepting bribery through those placement shares we talked about. The source calls this a testament to institutionalized corruption.
So the very people meant to police the market were allegedly part of the problem, according to this source.
That's the claim being made, yes. A deep-seated issue.
The source even names names, or at least points to groups linked to powerful figures like Salman F. Rahman.
It does mention powerful business groups, including those linked to figures like him, allegedly orchestrating manipulations, and it claims their influence reportedly persisted even after 2011.
Suggesting, according to the source, a lasting connection between political power and, well, alleged market manipulation.
A deep entanglement is how the source seems to frame it.
Okay, now the source also brings the banks into this picture, calls their actions reckless indulgence.
Yes, it claims banks and other financial institutions basically funneled huge amounts of depositor money, ordinary people's savings, directly into the stock market in 2009 and 2010.
And this did what?
Rapidly inflated share prices, according to the source, pushed them way beyond their actual value.
And what's the source's view on the central bank, the Bangladesh bank, during all this?
Quite critical. It claims that, far from being impartial, the central bank actively ignited this financial scam. Strong accusation there.
How so? Did they ignore warnings?
The source highlights an IMF warning from February 2010 about massive bank overexposure to the stock market. But the source states the central bank willfully ignored the systemic risk, becoming, in the source's view, an alleged enabler of the subsequent catastrophe.
Okay, so they allegedly ignored warnings. Then what happened when they did act?
Well, the source argues the intervention came way too late, and when the Bangladesh bank finally brought in restrictive policies in late 2010, the source uses this analogy, like slamming the brakes on a runaway train.
Meaning?
Mandating banks adjust illegally invested industrial loans caused, according to the source, a devastating liquidity crisis. Banks suddenly needed cash.
Which forced them to sell shares quickly.
Exactly. A fire sale of shares to raise that cash. And that, the source claims, triggered the market crash.
So the central bank's actions, described by the source as inconsistent and unsustainable policies,
allegedly exposed deep problems, deep structural vulnerabilities in the banking sector, and this dangerous intertwining with the speculative stock market.
It's painting a picture of a crisis where, well, multiple parts of the financial system allegedly played a significant role in the collapse.
That's definitely the narrative presented in the source.
And the aftermath, what does the source say about the consequences of this alleged collapse?
Tragic and widespread, according to the editorial. The human cost detailed includes shattered lives, widespread social unrest, furious protests, even suicides among devastated investors.
Just heartbreaking stories of loss.
Absolutely. While, and this is a quote, billions line the pockets of the corrupt.
And accountability. Was there any, according to the source, it mentions the Ibrahim Khalid report?
Yes, a comprehensive report that the source says unequivocally named the manipulators, but despite that.
Key players walked free.
That's what the source states. Key players walked free.
And the BSEC's actions, the punishment meted out.
Called a mockery of justice by the editorial, sending a message, in their view, that power, not law, dictated everything in Bangladesh's market.
So this perceived lack of consequences
Perpetuated, the source argues, a culture of gambling and fraud, because the rules could apparently be broken without real penalty.
which brings us to reforms. The source asks why past reforms failed. It mentions an implementation gap.
Right. Post-crash, things like demutualization, changing the stock exchange structure, and better surveillance were introduced, or at least initiated. But the source claims their effectiveness was basically crippled by persistent political interference and just a fundamental unwillingness to enforce regulations impartially.
And that white paper is mentioned again here.
Yes, cited as specifically criticizing later BSEC leadership for flouting these reforms, allegedly bringing the markets close to the brink of disasters again.
So this pattern, the source highlights recurring crashes under the same political party, failure to act on recommendations.
It points, according to the source, to a deeper systemic vulnerability. The market wasn't seen as a trusted platform for investment, more like a golden egg for political loyalists.
Okay. So putting all these points together, the alleged manipulation, the claimed complicity, the human cost, the lack of accountability, what's the bottom line from the source? Where does this leave things now? So what does this all mean?
Well, the source states the current interim government faces a, quote, mammoth task, a huge job if they want to dismantle this alleged legacy of corruption and, restore any kind of faith in the market.
And how does the source suggest they do that? What needs to happen?
First, it says dismantle the actual infrastructure of corruption that it claims is still in place.
Infrastructure of corruption. Okay, what else?
And crucially, ensure absolute uncompromising independence of the BSEC, the regulator. It needs to tear down the political chains that allegedly control it.
Independence for the regulator. Makes sense. And what about the alleged manipulators?
Ruthless prosecution of every single manipulator. That's the demand. Explicitly saying it must happen regardless of past connections or influence.
To establish deterrence, finally.
That seems to be the goal, yes, whereas allegedly absent before.
Anything else? Reforms? Funds?
Yes, effectively implement those stalled reforms. Strictly enforce regulations. Close that implementation gap. Also, establish a robust investor protection fund to protect small investors from future potential losses like these.
And involve more people.
Promote comprehensive dialogue, inclusive initiatives. Get all stakeholders involved, not just the powerful ones, to find sustainable solutions.
And Dr. Bhattacharya is quoted again near the end.
Yes, reiterating his point. Public confidence can't be restored, quote, without enforcing punitive measures against manipulators.
So real consequences are key in this view.
Absolutely. The source's final image on this is powerful. It says severe, swift penalties are needed for cauterizing this festering wound.
Cauterizing a wound suggests the problem is deep and needs aggressive action.
Exactly.
So, to quickly summarize the source's main message, it's a deeply critical view. A market allegedly engineered for plunder, for corruption, devastating human consequences for ordinary investors, the alleged victims, and a history marked by, well, a disturbing lack of accountability for those supposedly responsible.
That captures the essence of the editorial's claims, I think.
It really brings us back to that core issue the source keeps highlighting: trust, accountability. Can a system described like this ever really function the way a market should?
It's the fundamental question raised, isn't it?
And it leaves you, the listener, with a pretty powerful, provocative thought based on this source material. Can faith in such a system ever truly be restored? Especially without the huge changes and the accountability the source argues are absolutely necessary.
Or, as the source seems to suggest, will that specter of another catastrophic crash just keep hanging over everything until justice, for these past events anyway, is finally achieved.